Joining us now, J.P. Morgan Asset Management's David Kelly, Mayflower Advisors, Larry Glazer. It's good to see you both. Happy New Year. David, what do you think? Where are we going to go this year in the stock market?
Well, it's not going to be as good as last year. I think we can still probably, certainly for the first half of the year, move up. I think that what's really going on here is the Fed put in a relatively gratuitous set of rate cuts last year, but what that did is it put the yield on cash below inflation, and that means it's very hard to find another place domestically to put your money, and that's causing this flow of money into equities. I think that's really what's behind what we've seen in the last few months. I think the economy remains slow but stable, and that's probably allowing the stock market to continue to move up. But, longer term, people need to look longer term, and valuations are higher than average, and that means, muted returns over the next decade.
Larry, does that make sense to you, or do you have a different view?
I think it makes a lot of sense. Look, I think that as we turn the page into the new decade, into the new year, there's a tremendous sense of optimism on the heels of strong stock market gains and obviously the longest U.S. economic expansion in modern history. With that said, I think we always look forward to a chance for reflection in the new year, and reflection starts with your portfolio. There's two dynamics we look forward to every January. One is the so-called January effect, the end of that tax loss selling in December, much more muted than normal. We expect a more muted January bounce because of it. The other dynamic, of course, is window dressing. Window dressing was more pronounced last year. We saw Apple and Microsoft leading the market, 15% of the S&P returns. That is pushing people into technology names, losing their heads. Portfolio reflection means looking more broadly, looking outside. Today, PBOC, that injection of liquidity, emerging themes should be emerging markets. I agree with that. It means international. It means looking more broadly outside of last year's leadership, and it means rotation into 2020. That's what I'm much more excited about.
David, one of the things you highlight in your recent note is the focus on, or the fact that you're focused on some longer-term concerns. What are they and why?
Yep. Yeah, one of them is population growth. On December 30th, one of the quietest days of the year, the Census Bureau released numbers which showed the slowest percentage population growth in a century, since the influenza of 1918. We've got a declining growth, a declining immigration, and we've got the lowest birth rate in 32 years. And if you feed this into economic models, what it suggests is we're locking in 2% growth. We're not going to be able to do better than that unless we have more immigration or some huge surge in capital spending that we don't expect here. So we've got slow U.S. growth. And if you look at the end of, we ended the last decade with international equities looking a lot cheaper than U.S. equities. I think one of the keys for the decade ahead is making sure you've got enough international exposure. I understand people's nervousness and the disappointment in the last few years. Make sure you have that because they are cheaper and the rest of the world will grow faster than the U.S. in the years ahead.
And I think, by the way, I think David makes a really good point that diversification doesn't mean owning Apple or Microsoft. It means owning other companies, it means owning other countries, other industries. The rotation that we saw in energy names coming in, I think, is a sign of things to come. It's about growth, not just about multiple expansion. Last year, tech was all about multiple expansion. We need to look more broadly, wait for the earnings to come out to see if the fundamentals can catch up with the stock market performance that we saw last year.
David, though, just on that idea that we kind of maybe stuck in a 2% track, the 2.22 backdrop has been pretty good for financial assets, right? 2% growth, 2% treasury yields, give or take, 2% inflation. So does that just mean that we keep kind of revaluing incrementally higher in that type of environment?
Only for a while, because there is a squeeze on profits going up. The good news is I think we can probably avoid a recession over the next year. This is a very stable, slow-growing economy. The bad news for profits is that we are seeing some growth in wages, and that's nice for workers, but it is squeezing those profit margins. So, yes, from a financial perspective, stocks look attractive, but I think profit growth will be low single digits in the year ahead. And, if you have any bump in the road in terms of demand, it could be worse than that. And so I think that there are some limits here. So people just need to be careful. We shouldn't get too giddy, and the stock market's really telling you of an economy that's better than the one that we really have.